Hey guys, so this is part 2 of my run through of my first spreadsheet, the stock valuation spreadsheet, which employs the dividend discount model and the CAPM. So in this video we're going to run through the VBA coding in the background. So we'll just switch to VBA. Okay, so this module, mod beta, is the module for the first CAPM model that we looked at in the previous video. So this is calculating, this beta market day is calculating all the sample statistics for this set of data right here. So it just basically imports all the data from the spreadsheet, the market data and the stock data. It determines the last date of daily stock returns, the last date of daily market returns, and then finds the max of that. Then we're populating an array here that has trading dates which are common between both the market and the stock. So we're only comparing data which is available for both the stock and the market. Here we're populating our holding period return array. So that's holding period return for the stock in column 3, holding period return for the market in column 4. And then here we're also calculating, this is not part of the array, but we're calculating the expected stock return and the expected market return and the average stock return and the average market return. So that's a iterative process. Finds this particular loop of use. Okay, and now we download the variances and expected values. So basically the running total that we calculated up here, we just divide by common dates for the average, and same for the market. And here, because we used compounding, we just raise to the negative power and subtract 1 at the end. And for the variance and covariance, first equate them to 0. Then we have a running total or running summation here. So that's just your typical variance formula. So you've got your mean here, you've got the particular return, find the difference and then square it, and we're doing that for both the stock and the market. Covariance, typical, your normal covariance formula, you've just got your, so you've got your stock here, the difference between the mean and the return, and then you've got your market here, the difference between the mean and the return, and then you're multiplying them together. And from there we can calculate our important statistics. So we've got the average or the expected return for the stock and for the market. We've got the variance for the stock, variance for the market, and then we've got the covariance row, which is our correlation, and beta, which is the important one. And moving down to beta sector day, which is essentially the same as what we previously looked at, except instead of using the ASX 200 as a comparison, it's using the transportation sector as a comparison. So we'll just breeze over that one. And here we step on to beta market week, which is just comparing the stock with the market, but with weekly holding period returns as opposed to daily. So that's pretty similar to what we saw before, determining the last and first dates which are common between the stock and market. Common weeks, so instead of common dates, we're just populating an array that has common trading weeks between the stock and the market. So we're only comparing common data. Our holding period return array, as before. This one was a little bit more involved since we had to select the end of the week as opposed to every single day. If it wasn't Friday, then it would be Thursday, and so on and so forth. So that's just what this extra bit of coding's for. Then we move on to the variances and expected values. The rest here is the same as what we saw above. And moving on. Sector, same as the above, except using the transportation sector as opposed to the ASX 200. The rest is pretty well comparable, just a few minor variations, so we won't spend too much time on that. But what we have is subroutines for daily, monthly, weekly, and yearly holding period returns for both market comparisons or ASX comparisons and sector comparisons or transportation sector comparisons. Alright, so we'll jump on over to mod beta 2, which is the coding behind the second CAPM model we looked at. So the coding for this page. This is a little different in that these subroutines don't actually calculate the covariance or the variance or the correlation between the stock and the market, for example, or the stock and the sector. They simply calculate average yearly returns based on daily, weekly, monthly compounding. So we'll start with the market returns. So we extract all the data that we need from the spreadsheet that we downloaded earlier. We determine suitable first and last dates. We populate the holding period return array for weekly compounding, similar to what we did with the other subroutines, the other CAPM model. And we do the same for a monthly holding period return array. Then we begin the calculation for the annual returns with the varying compounding durations. So with daily compounding over a 1 year period, so that just loops over each trading day in that year and compounds the returns of each trading day to form an average for that year with daily compounding. Similar for weekly, that compounds the weekly holding period returns for that whole year. So say 51, 52 trading weeks. And then similar for monthly, so 12 trading months per year. It compounds them and provides a yearly average. And then it repeats that for each year where data is available and then prints to the screen. Basically the same process is repeated for the stock returns and also the sector returns. So from there we get the average yearly returns that we saw previously. So for the 2013 financial year with daily compounding, we had an average annual return of almost 14% for the market, ASX 200. And with weekly returns, we had a better return. So in my opinion, that's slightly less accurate because there's less data points essentially. And again, even less accurate for monthly compounding. Okay. And then we'll just quickly run through the subroutines which download the data from the web. So we've got the Yahoo update, which is updating this information here, just from Yahoo Finance. So it's just using the Yahoo Finance API symbols here and downloads it into a CSV file, which is then modified with this code here to be a more suitable format, and then it's just printed to the spreadsheet. Update listings date. This bit of code just downloads the date the stock was listed on the ASX. I haven't actually incorporated it into this version of the spreadsheet, but if you like, you can modify the spreadsheet and incorporate that. Bond prices, so this just gets the current bond information, bond yields from Bloomberg. There's just a table on the Bloomberg website which I just scrape information from using this code. Interest rates from the Reserve Bank Australia website. Similarly, it's a table which I just scrape information from. The same for the inflation rate from RBA website. Yahoo Beta. This one is also not incorporated into this version of the spreadsheet, as Yahoo Finance rarely has beta data available for companies, at least ASX listed companies. So that code's there if you want to use it, but it's not currently incorporated into the spreadsheet. And this updates the ASX list, gets the latest one from ASX.com, downloads a CSV file, and then copies it into the spreadsheet. Alright guys, so that pretty well wraps it up. I hope you've enjoyed this instructional video, and I hope you find the spreadsheet useful. Feel free to leave any comments if you have any issues, and I'll try my best to fix it up. And yeah, please subscribe and stay tuned for the next spreadsheet, which should be up shortly.